talk now about how to pay for a deal, okay? We talked about synergies, we talked about how to value synergies, and we talked about how to price a deal given the synergies. But now what we're going to learn is that acquirers can choose to pay either cash or stock, okay? So deals are not necessarily paid off with cash, as in this picture. In sometimes what the target is going to get is stock in the merged company. So now what we're going to figure out is what the key difference is, okay? Let's go back to HP Compaq, okay? Suppose that the final price is 27. We just figured out that the price had to be between 21 and 34, okay, given our valuation of synergies. So let's say the price was 27. I'm going to show you in a second what the price actually was, okay? Let's say for now it was 27. Compaq had $1.7 billion outstanding approximately. So if you do the math, this is going to represent $16 a share, okay? So think about this. If you're paying cash, you're going to pay $16 a share. What happens? HP takes cash out of its pocket, okay, and gives to Compaq shareholders, right? Compaq shareholders give their shares to HP, and they get $16 in cash. Okay, so paying cash is extremely simple. We wouldn't even need to be talking about it if there wasn't another way to pay for a deal. So really the most interesting thing that we have to learn here is that in some cases, companies are paying with stock. Okay? How does this work? It's actually an issuance. Okay? It's a stock issuance. What HP is going to do is to issue new shares, okay, and give the shares to Compaq shareholders in exchange for Compaq shares. So Compaq disappears, of course, right? Compaq is going to disappear, so the shares of Compaq disappear. In exchange for the shares of Compaq, the shareholders of Compaq are going to get shares of HP, and of course HP is going to become the new merged firm. Okay? A key variable in a stock merger is what we think of, what we call the exchange ratio. Okay? What is the exchange ratio? The exchange ratio is the number of shares of the acquirer that each target shareholder receives. So in this case, it's the number of shares of Hewlett-Packard that each Compaq shareholder is going to receive. Right? That's how HP is going to pay for the deal. Okay? What should be the exchange ratio then? Right? What is the exchange ratio? Let's go back to our $16 number, okay? Let's say that the final price is $27 billion, and let's say then that HP is paying $16 a share, right? If you think about the math, for a Compaq shareholder to get $16, you have, and remember what you're going to get is you're going to get HP stock, okay? So the exchange ratio, right, the number of shares that you're getting, okay, times the HP stock price has to equal $16, okay? So let's see how the math works, right? Notice that to do this calculation, we have to make an assumption about the stock price, right? As we're going to see next, and I think we talked about this in the course already in Module 1, the stock market is going to react to the deal, right? But let's say that we use HP's pre-deal stock price to do this calculation, okay? We already learned that HP's pre-deal stock price was $21, okay? So, right, the way the math works here is that, if you want to get $16, you have to divide 16 by 23.21, right? And this is how you would compute the exchange ratio, okay? What does this mean, right? It means that if you own 10 shares of Compaq, okay, and then the deal is financed with stock, you would receive 6.9 shares of HP. Okay, that's what the math comes up to. Okay, it's a 0.69 exchange ratio. Okay, so if you own 100 shares of Compaq, just to make the number round, you would receive 69 shares of Hewlett-Packard. Okay, this particular merger was financed. Well, it actually happened to be financed by stock, so HP didn't use cash at all, okay? And the exchange ratio was 0.6325. So it's not too far from what we computed, right? So if a Compaq shareholder had 1,000 shares of Compaq, you got 632.5 shares, okay? And then, of course, there are legal ways to deal with these decimals, okay? So that's how HP actually paid for Compaq. And here comes something really interesting. We saw this graph already in Module 1, okay? What happened when HP announced this deal, okay? The stock market reacted immediately, right? On September 5th of 2001, the stock market reacted to this deal, and actually what the market did is it sent HP's stock price down by 23 minus 18 by $5 a share. Okay, used to be 23. In the day after it started trading, after the deal was announced, HP stock price went down to 18. Okay, so the deal was very poorly received by the market. Okay, and remember, Compaq shareholders are paid in stock. So what they are getting is stock. So let's try to figure out how much was HP's offer worth following the market reaction. Think about this. The actual value of the offer after the announcement was much lower, right? Instead of 23, okay, you have 18 here. The exchange ratio is still the same, okay? So what Compaq shareholders are getting is actually 11.4, right? Compaq stock price prior to the deal was 12.35, okay? So it really didn't make much sense, right? At that point, right, what should have happened to Compaq stock price? After the deal was announced, Compaq stock price should have gone down as well, right? Which is exactly what happened. The deal was announced at this exchange ratio. The market hated the deal so much that even the stock price of the target went down in this case, okay? So Compaq stock price also decreased. And the surprising thing in this deal is that the Compaq management actually managed to convince the shareholders that the market reaction was to be ignored. Okay, so the opposition to this deal actually came from within Hewlett-Packard rather than from Compaq shareholders. Okay, and this is an example that we can generalize. Okay, and we can think about what happens when mergers are announced. In the general, we have evidence about that in the finance literature. Okay, M&A deals are very interesting because they give us a chance to look at how the market reacts. Right, this is what we just did. We're thinking about HP Compaq. There was a management forecast, the synergies, and all that. But then the market is going to do its own calculation, right? And it's obvious that if the merger is positive NPV for the acquirer, as we already learned in this course, then stock prices should go up, right? If the merger is positive NPV for the target, which in the case of Compaq it wasn't that clear, right? Stock price of the target should go up. So let's see what happens on average. Okay? So this is a graph that comes from a famous research paper on M&A deals. Okay? What it's showing is that the stock price reaction for target companies. Okay, so when a deal is announced, this is what happens on average to the stock price of a target. Okay, targets end up earning a significant premium on average, right? So when a deal is announced, the stock price of the target shoots up by here you have a number between 15 and 20%. Okay. So stock prices of targets are going up significantly. Notice also that there is a little bit of a trend here before the deal is announced. Of course, what happens in the real world is that in some cases there are rumors that ends up trickling to the market. So the target stock price may end up reacting a little bit before the deal is announced. Okay, that's why this graph starts a few days earlier. It's not just a 3-day announcement return or a 1-day announcement return as we did with HP Compaq. Okay. What about acquirers? Acquirers actually, what you see is a flat line on average. Okay. So the acquired stock price on average doesn't seem to increase when a new M&A deal is announced. Okay. Of course, that doesn't mean that all deals are 0 NPV, but on average, that's what we find. Okay. The bottom line is that what the research seems to suggest is that on average, mergers create value, but most of the value ends up going to the target firm. Okay? Right? So remember our discussion about synergies and premium, right? What this means is that mergers do generate synergies, right? So targets get a very high NPV if you want, right? Because their stock price is going up by 20% on average, but the acquirer end up paying too much. Okay, so all the premium goes to the target, and none of the premium stays with the acquirer on average, of course, right? So that's what the evidence shows. You know, so the negative reaction that happened to Hewlett-Packard is a little bit extreme, but there are many deals that are actually not successful for acquirers, at least in the short term. Okay? Of course, that, you know, the short-term stock price reaction may not be right, as we discussed already. You know, in the course, the market is trying to do this calculation, trying to figure out what's going to happen in the future, right? Is this deal going to add value or not? And you know, this is a very hard calculation to do, right? It's possible that the management was right, okay? Compaq, the management actually liked this deal. They wanted to be acquired by HP. They managed to convince the shareholders to go along, okay? So what can we do to try to figure out, right? The first thing you might be thinking is that we can try to look at long-term stock price reactions. Instead of just looking at the short term, how the market reacts immediately to a deal, let's try to see what happens in the long term. Okay? We can certainly do that. This is what you have here in this graph. Okay? So the deal, this is 2001 here at the left corner. So that's when the deal was announced. And here the blue line is HP. Okay? And then you have two other companies that you, to compare the stock prices to. Actually, the red line is an index. This is the S&P 500 index. Okay? And here in the bottom, you have IBM. Okay? If you read the management description of the HP Compaq merger, they were mostly concerned with IBM and Dell. Those were the main competitors of HP at that time. Okay? So what do we see here? Right? This is 2002, you know, up to 2007. Okay? It seems that HP actually did pretty well, right? When you look at this on the face of it, right? HP did significantly better than the competitor. Okay? It seems that HP did pretty well in the years following the merger. Okay? Of course, you know, there is a problem with doing long-term stock price reactions. You know, it's very difficult to find a good comparison, right? What we would like to see is, you know, suppose the deal had never happened. Suppose HP had not acquired Compaq. Okay, what would have happened to HP's stock price? But that will, you know, this we will never know. Okay, right? So the only thing we can do is to compare to competitors, compare to the market. You know, in this case, it seems that at least there is no evidence that the merger was destroying value if we're looking 6-7 years ahead. Okay. We can also do qualitative analysis to think about this deal. So here I have two articles for you. Okay? The first one is from Fortune. Okay? And the article was actually about the fact that the deal was failing. Okay? So you can read here, you know, buying Compaq has not paid off for HP investors, not by a long shot. Okay? Which seems to be a little bit inconsistent with the stock price chart that you just saw. And you know, we can also find an article that says that the merger worked. Okay, this is the merger that worked, HP and Compaq. Okay, and you know, this article is talking precisely about the fact that this deal was very poorly received by the market, but in the long term, it ended up creating shareholder value. The bottom line is that, you know, we never know. Okay. This is a big problem with M&A research and trying to understand M&A in the real world, is that it's very difficult for outside observers and sometimes even for management to figure out if a deal worked in the long term or not. So sometimes, you know, in most cases, you have to rely on your intuition, and you have to you know, you can of course observe the short-term market reaction, but the long-term market reaction and this qualitative reaction to the deal is a little bit harder to interpret.